CFO of LSA Portfolio Analytics. We have the great honor of being joined today by Sam Wardwell, and it's a pleasure because he's actually sitting in our office, which is very rare that the chief economist for Pioneer has an opportunity to get out to Kansas City and actually join us here. So, Sam, thank you so much for being here. As most of you guys know, on these calls, we like to get good insight in terms of what's going on in the economy and the marketplace so that we have good talking points to be able to share with our clients and prospects as we're meeting with them. And for those of you that have been to some of the previous LSA national conferences, Sam has been a keynote presenter now at the last two LSA conferences. So it's a great pleasure to have him. And with that said, I'm going to turn it over to Sam so we can get an economic update. Sam, thank you.
Well, thanks very much. Thanks for the opportunity, and for those folks who are listening in, thanks for taking the time to listen in. As we look at the U.S. economy, we're feeling pretty good about things. But let me step back before I go there and just a quick tour around the world. The headlines are probably more pessimistic than the reality. If we look at Europe, Europe is definitely improving. The recession is over. They are in, let's call it the third inning. They're early stages, but it's getting better and better. The biggest threat in Europe is not Greece. Greece is, relatively speaking, the Kardashians of Europe. 2% of the economy, and if they'd gone belly up 5 years ago, it would have been a Lehman moment for the European banking system. If they default this week, it's painful for the ECB, the EU, and the IMF, but it doesn't blow the banking system up. And so we think that that's not the greatest risk. Frankly, the greatest risk in Europe is the geopolitical risk with Russia. And we're hoping, and we're reasonably optimistic, trying to understand Putin's motives, that this is not going to go south. But I say I worry more about Russia than I worry about Greece. But those are, shall we call it, storm clouds on the horizon of what's a pretty good outlook away from those risks. If we look at Japan, the big tax hike a year ago, on April Fool's Day a year ago, threw the Japanese economy into recession. The year-over-year comparisons are hard to make sense of because of the impacts of the tax increase on the economy. But what you do see in Japan is the economy looks pretty strong, and it looks like it's getting better. The yen has gone down. The export-oriented companies' profits are up. Companies are becoming more shareholder-minded. Unemployment rate is below 3.5%. Things are definitely improving. And also, I have to say, in the case of Japan, and also in the case of Europe, since they import a lot of their energy, Japan imports most of its energy, the lower price of oil is a big tailwind for those economies. China is definitely slowing down, and China has kept its currency essentially pegged to the U.S. dollar for the last year and a half, and that means its currency has appreciated relative to the yen and the euro. So that's been a drag on the Chinese economy. We think the drag is going to continue. We think emerging markets are going to struggle economically because of the slowdown in China. But at the same time, China's economy has some pretty good things going on, and there's plenty of room for the Chinese to ease both fiscal and monetary policy to maintain growth at an acceptable level. And that the focus of the Chinese government at this time is on maintaining growth at an acceptable level and keeping the unemployment rate low. And so we are not pessimistic about the outcome there. We just look at these things and we say, you got a little bit of reason to be cautious. Now, with that said, the global context in the aggregate is improving. The IMF and the people like that have been raising their estimates of global economic growth. So the backdrop is improving. If we look at the U.S., don't worry about first quarter GDP. It's probably going to be revised to a negative number, but you've got a huge weather impacts driving through that. I just saw this morning that pending home sales in the Northeast were up 10% month over month because the snow is gone. Nobody goes house hunting when there's snow on the ground. And so we're seeing the weather clearing up, and we think that that is going to improve. What I focus on when I look at the U.S. economy is employment, and employment is rising steadily. The number of job openings is about 5 million. The number of people getting laid off is 270,000 people a week on average, which is a 15-year low, or within spitting distance of a 15-year low. The average hourly work week is long. Average hourly wages are rising. After-tax take-home pay of the American consumer, after inflation, after taxes, is at an all-time high and rising fast. The only reason it hasn't shown up in GDP is because consumers continue to pay off their credit cards, pay down their mortgage debts. They are not borrowing, they are saving. And that, in the short run, is bad for the merchants, but in the intermediate to longer run, you have a very, very healthy consumer. The U.S. consumer has more ability to take on additional debt than it's had at any time in the past 35 years. They just are very cautious about doing that. But a cautious consumer is much safer for the economy than an irrationally exuberant one. And there is no irrational exuberance out there in the business sector or in the consumer sector. And so as we look at it, we have a very healthy and, dare I say, sober economy out there. And it's not a party. But parties are what give you hangovers. And so as we look at the recession risks in the U.S. are essentially negligible unless there is an external shock, a terrorist strike, a Mideast war, something happens. But if nothing happens, then the forecast between now and the presidential election, call it 18 months from now, is that generally the Main Street economy is going to do better. Now, when we look at capital markets, the Fed has made it pretty clear that they intend to start raising the Fed funds rate by the end of this year. June is probably not going to happen. September is likely. If it doesn't happen in September, it's almost certainly going to happen in December. But there's, let's say, the people who are hoping for it not to happen until 2016, I think those people are going to be disappointed. Our expectation is that the Fed is committed to moving by the end of this year. But it will not be like in past Fed cycles where they raise 25 basis points at every meeting. The Fed is still committed to erring on the side of easing tightening too slowly and tightening late, because it wants to make sure that it does not cut off the U.S. economic expansion. It is simply removing the amount of stimulus. It's not moving into a contractionary move. It's easing the pressure on the gas pedal. It is not reaching for the brake pedal, nothing close to reaching for the brake pedal. The European Central Bank is continuing to do quantitative easing. The Bank of Japan is continuing to do quantitative easing. On a global basis, the liquidity is very, very accommodative. So global financial conditions are still accommodative, but the Fed is going to start raising rates at the end of this year. And it's because the Fed thinks that the U.S. economy is healthy enough that it can get away from the zero interest rate policy, but it's going to do so slowly and gradually. If we look at the stock markets, they look kind of expensive, but everybody looks at the stock market and says it looks kind of expensive. Janet Yellen got quoted in the newspaper on this about a month ago, but if you look at the total context of what she said, the stock market was kind of expensive compared to its own history. But if you look at it compared to the bond market, it doesn't look bad. If you look at there's everything looks a little bit funny, because when you have a zero interest rate environment and when you have a 2% inflation environment, valuations do look high because you're in a low inflation rate, low interest rate environment, and so there's no bubbles out there that we're afraid of. Our view is that this is still an environment where money can be made. When central banks print money, when financial conditions are accommodative, there is still money to be made. So let me stop at that point. And
yeah, Sam, let's dig into some of the big key points so far in 2015. Can you talk a little bit about the strength of the dollar? Historically, credit cycles seem to be strong in terms of nature, or currency cycles seem to be strong and longer in duration. Is there legs to this current strong dollar?
Yeah, the dollar made a very sharp move, and I can't remember exactly, but say something like 8% in 3 months, but I mean, surprisingly fast move. Our expectation is that what we have seen was a bit of a pullback. The dollar got a little bit overbought. The long dollar short the euro, long dollar short the yen trade got kind of crowded. And so what we saw was a normal sort of pullback from an overcrowded trade. But our belief is the trend will continue. And so as we look forward over the next couple of years, let's say the yen is right now in the, call it 120s, and maybe it goes into the 140s. The euro is around 110, and it goes down to par or something like that, another 10% or another 15% over a couple of years, not necessarily in a straight line. this is one of the, as we look at it, this is a normal economic process. When an economy is strong, its currency rises, and that is how global economies rebalance themselves. The weaker currency in Europe and the weaker currency in Japan are helping those economies do better. They are a headwind for the U.S. economy, which is the strongest, and that is how global economies work. And this is all, shall we say, perfectly normal and appropriate. To some extent, the stronger dollar does have a negative impact on the U.S. economy, and that means that the Fed doesn't have to raise rates as quickly as it would otherwise. And so in a lot of ways, it's a bond market friendly policy. The impact on corporate profits, I think, is a lot bigger than the impact on the economy. Because if you think about, let's say, not picking on anybody in particular, but Coca-Cola earns most of its revenues outside the U.S. in pesos and yen and euros and whatever. When they convert those back into dollars and the dollar is stronger, Coke's profits go down, but it does not cause job losses inside the U.S. When Boeing loses market share to Airbus, it does cause job losses inside the U.S. But what we're seeing, I'd say, if we look at corporate profits, is we're seeing a lot of what I'll call the Coca-Cola effect and not very much of the Boeing effect. And so in that sense, I'm not too worried about the strong dollar.
Okay. Sam, talk to us about, we're hearing from more economists about the importance of having more of an international or global presence inside a portfolio. And you touched on this. Valuations are high inside the U.S. equity markets relative to what we don't know. But could they continue to go up? Yes. I guess the 80s and 90s we were at high valuations. Markets kept screaming up for a number of years. But do you think it's important that given the markets are at a high valuation level in the U.S., to start spreading that risk a little bit overseas, and where are you seeing that pocket of value?
No, we absolutely would say this is a good time to go global. And to some extent, what happened in 2014 was being all in the U.S. was the best strategy. Naturally, that unwinds. In 2015, being international is the winning strategy. And this is the way markets work. But there is an old rule in markets called "Don't fight the Fed." And if you look at what happened when the Fed did QE, the stock market went up. Now the Fed stopped doing QE, but they're doing QE in Europe and in Japan. And the European stock market and the Japanese stock market are going up. And I sort of go, don't fight the Fed, don't fight the BOJ, don't fight the ECB. So as we look at it, we think that a globally diversified portfolio in the developed market world, where we have meaningful exposure to Japan, meaningful exposure to Europe, got to do stock picking and have the right sectors everywhere, of course, but should be a better absolute and risk-adjusted return than, let's call it, just the S&P 500 taken alone. If we look at emerging markets, it's much more complicated because there are countries that benefit from high oil prices. There are countries that benefit from low oil prices. But if you think only of the emerging markets index, we would say we would be more cautious about emerging markets than about Europe or Japan. Still opportunity for something, but not as good an opportunity as developed markets.
You know, gold has been hitting the headlines the last couple of weeks. Can you give us some insight of your view on gold? Is it going to be bouncing back to the upside, or are we kind of continuing to bounce around range bound for a while here?
We don't tend to pay very much attention to gold. Bonds pay coupons, stocks pay dividends, gold just costs you money to store. It's not a productive asset. Gold is a very, very good hedge against currency depreciation. And so if you look at gold in U.S. dollar terms, with the U.S. currency strong and with the Fed raising interest rates, we think gold in dollar terms is relatively unattractive. But if you look at, if you're Japanese and the Bank of Japan is printing money and the yen is going down, the chart of gold in yen terms looks much, much more attractive. But from our point of view, a U.S.-based investor in a rising interest rate, strong currency environment probably doesn't make big money in gold. Again, if you're European or Japanese, it might look different. From the U.S. point of view, we would be on the negative viewpoint.
So let's turn the tables to the fixed income side for just a minute. And I know you mentioned June seems to be off the table. September is still likely. It does seem like the Fed wants to make a move at some point this year. I think one of the big fears of a lot of advisors out there, and of LSA as well, is if we get into a rising interest rate environment where the U.S. equity markets find themselves under pressure as well, it's kind of like that 2008 environment where you're getting hit on both sides of the aisle. And I'm not suggesting that we have another pullback like 2008 by any means, but it's hard because now if your fixed income, which is traditionally hedging your equities, is working against you at the same time that equities are correcting, where do you go to hide? And do you think that this is going to play out in that type of a format?
That fear is everywhere. And I would say the fear is, based on fact and based on history. And to say that you shouldn't be aware of the risk is craziness. So, yeah, we are very aware of the risk. As we look at it, given, our expectations are the Fed moves a little bit, but when the Fed starts to move, let's say take the Fed funds rate up to 1%, it won't really slow the economy down. It won't cause a recession. What will probably happen is that all the retired people who've been sitting in 0% money market funds and 0% CDs, they'll have more income. And in fact, in a perverse way, when the Fed starts raising interest rates, the economy might react positively to higher interest rates because retired people will have more income. And in that scenario, a stock market correction would definitely be a buying opportunity. At the same time, when we look at the fixed income markets, we think about where the 10-year Treasury should be in the longer run. And the concern we have about the Treasury yield curve is that it's acting as if the Fed's never going to raise rates back up again. And that's sort of like thinking that stocks never go down or house prices never go down. Bond prices do go down. And right now you're not getting a whole lot of yield. And so our position in the fixed income markets is pretty defensive in terms of duration. We have got we are positioned so that if interest rates rise, we won't lose as much as the bond market. But in equities, the view is hold firm, and if there is a correction, buy the dip.
So you mentioned where the 10-year should be. Can you state where you think the 10-year should be after we 3 years out, 4 years out of where you have targeted at?
Let's assume for the sake of argument that we're not worried about where we are going into a recession or coming out of a recession. But in a normal, steady state, solid economy that's at full employment and staying at full employment, the Fed funds rate probably should be, call it, if inflation's around 2, the Fed funds rate should be 3-ish, and the 10-year Treasury should be 4-ish. But that's not to say that we get there in anything approaching a straight line. But from our mindset, 4-ish in the long run model is something close to fair value.
Well, we've seen the 10-year start trending up here lately, right?
Yeah.
Is this markets trying to get ahead of Janet Yellen and the rise in interest rates, and is it indicating that, yes, September is very much still on the table?
Well, to some extent, yes. To some extent, no. To some extent, people, I think, are they look at 2% 10-year Treasuries or 2.25% 10-year Treasuries, and they think it's not really a great long-term investment. But when we look at how the bond market is behaving, it's really been more in a trading range, going up and down, and it gets up to about 2.25%, and then it comes down again. And this is still acting, it's down to, what, 2.15 or something yesterday. It's acting like it's still in a trading range. This is not a panic sell-off yet. This is not a taper tantrum yet. The risk of one is out there, but we don't think it's happening now. What happened in Europe was you had a pretty sharp sell-off, and we think a lot of that spread across the Atlantic. But that sell-off in Europe has stopped and is moving the other direction, and the U.S. bond market is rallying. So our view is that this is not the beginning of a tantrum. With that said, I would also say that if you think about things like the 30-year Treasury, the 30-year Treasury is scared of inflation. It's not scared of recessions. The 30-year Treasury does not get too upset when the Fed starts raising rates, because at the margin, when the Fed starts raising rates, it means less risk of inflation. And the 30-year Treasury, the long end of the yield curve, might hold in better than the 2s and the 3s and the 5s.
And that's a great point. So you mentioned earlier that you're focused on duration, and I'm going to assume when you made that statement that you're on the shorter side of the curve as it exists today. But based on that statement, there seems to be some volatility from the yield curve flattening or normalizing back to a traditional 4.2 level on a 10-year, which seems to be the historic average. Does that suggest that there's greater volatility on the NAV price of shorter duration bond funds?
I think that because short duration tends to lead to low volatility, you probably have less vol, but you're getting so much less yield at the short end, your total return prospects in the, call it, 2 to 5 year space don't look very attractive. So in our fixed income portfolios, to the extent that we have taken a short duration position, we have taken it by getting rid of, if you think about interest rate buckets, we want to be out of the 2 year bucket, we want to be out of the 5 year bucket, we want to be out of the 7 year bucket, and maybe neutral in the 10, 20, and 30 year buckets. And so we have a short duration position, but most of that short duration position is from 1 to 10 years, where we expect as the Fed funds rate moves up, the yield curve in the short end flattens. Because right now, from cash to 10s is, call it, 2%, and that's probably flattens out a lot when the Fed starts raising rates.
Can you talk a little bit about some of the credit-sensitive asset classes like high yields or bank loans? Are we in late innings in high yield? The spreads seem to be compressing a little bit. Do we still have a little bit of juice left there? And I guess just as importantly, bank loans, and are they still going to be a good vehicle in a rising interest rate?
Well, we have to look at two things here. Number one, we look at just how much are you being paid to take default risk, and what's the probability of default and the probability of loss. And if we look at it in this sense, we would say that people are still being paid well, maybe too well, to take credit risk. And we are still in a, let's call it, risk-on position here. The high-yield bond market had a very tough fourth quarter because roughly 1/6 of the high-yield bond market was energy-linked paper. And when oil prices started falling, people got very scared of that. With oil prices having found a bottom, and I'm not saying that we think oil prices are going back to 100. We think oil prices are sort of going to be range-bound around where they are for the next couple of years. The rest of the high-yield bond market that's not energy, lower energy prices are good for the economy. It's a giant tax cut for the economy. It's economic stimulus. Risk of defaults is lowered by that, and the energy sector seems to have stabilized. So from our perspective, you're not getting paid a lot to own high-yield bonds, but you're getting paid more than enough. And so from our position, from our point of view, we still are very low average credit quality, very high exposure to high-yield paper. The problem you have, to some extent in the high-yield bonds, to a larger extent in the loan market, is what you alluded to earlier, which is liquidity. If everybody tries to get through the door at once, the door is not wide enough. And that's what we saw in 2008 in a very bad way. And that's sort of your classic flash crash is when people are caught by surprise and they panic. Then you get big spreads widening. The floating rate market, we think, is perhaps more susceptible to that than the high yield bond market. And so in our floating rate portfolios, we're really much more focused on the quality of the paper. We want to be higher quality there because if the sell-off comes and you can't sell your position, you want to make sure it's a position, as I sort of go, you can dance with some girls, you only marry others. And we want, in floating rate space, we want to be able to marry whatever we are dancing with. But broadly speaking, we are still comfortable with those asset classes.
Okay. Let's switch to U.S. equities again for just a minute. And first quarter, we saw small caps do extremely well. And I'm alluding a lot of that to the strong dollar. And so I guess the question is there enough in the cards to see a continuation of outperformance of small caps versus large caps, or was this a pocket of outperformance in a cycle that the dollar was just screaming up, or do you even relate the dollar strength to the success of small caps in the first quarter?
No, definitely. I think the dollar had a lot to do with the strength of small caps. The small cap stocks tend to be more focused on the U.S. economy. Now, U.S. economy GDP was lousy in the first quarter, but the longer term picture is the U.S. economy is fine, and so that small caps in that sense are happy. The weakness in large caps was what I would call, in large part, let's call it the Coca-Cola problem. It was strength of the dollar leading to downward estimate revisions. And so we had, going in, we saw huge estimate revisions downward, and then the actual earnings came in much better than the pessimistic expectations. I think the original estimates at the beginning of earnings season was for maybe negative 6% year on year, and the final numbers are +1 or +2 year on year. So it wasn't as bad as people feared. If we look over the, let's call it longer term, I'm not negative on small caps and not negative on mid caps at all, but from a valuation point of view, small caps have been outperforming large for 15 years or so, and on a valuation basis, they look kind of expensive. And you know, in a lot of ways, you think of bubbles and tech bubbles, but the tech stocks, and I'm not advocating that, you know, people go out and buy tech stocks, but if you look at the Intels, Microsofts, Apples, Googles, whatever's, they're not trading at bubbly valuations, and a lot of the healthcare stocks in the large cap, so large cap growth space, and a little bit of a bias towards growth over value, but that's not where you have to worry about valuations. The social media, the biotechs, if there are bubbles, and the Fed has talked about those are in the smaller caps space, and so we think large caps are very attractive.
You mentioned healthcare, and it's been a position inside our portfolios for a couple of years now, and you do start to get a little bit weary after you've had such a big run-up. Do you see any major disruption? I guess April put a little bit of fear back into everybody as healthcare was correcting a little bit, but do you see a continuation of upside opportunity that exists inside healthcare?
Well, if we look at the biotech sector, which is where a lot of the volatility has been, our biotech analyst says the thing we have to understand is the science is radically different than it was 10 or 15 years ago. And it's, you know, instead of putting a petri dish on a windowsill, it's like using a laser sniper rifle. You know exactly where on the DNA chain you want to flip a molecule, and you have a wrench to flip the molecule. And he says, you know, so it's the science. A lot of the science is very real. But if you're playing the small cap bios, that's really venture capital. But if leaving biotech aside, and so there's some issues in biotech. The bigger surprise, but he's saying, you know, yeah, you get some volatility, but the science is real, and the demographics of aging are real, and you know, people get old, they need more healthcare. The thing that's maybe the biggest wild card is what does the Supreme Court do in June with the challenge to subsidies under the Affordable Care Act? And part of the reason that healthcare has been so good for the past 5 years is the CEOs of large cap companies are very good at figuring out where the federal dollars are going to flow and positioning their companies to take advantage of that. And if the Supreme Court vetoes effectively the subsidies under the Affordable Care Act, then it's a free-for-all. And nobody's really sure what the policy outcome will be, what Congress will do, what the president will do. And a lot of the companies that have been doing very well because of the Affordable Care Act will have to scramble. And I am not telling you what you should do, and I'm not telling you what our portfolio manager should do, but it's, as I said ago, that's the one that we think about. Where's the surprise coming from? That's the place where the surprise could come from. So, you know, in June there could be a lot of repositioning of portfolios because there's a yes or no outcome, and nobody knows. Some people are positioning for yes, and some people are positioning for no, and we just don't know what the answer is going to be.
So let's wrap up with this final question, Sam, and that is, on everybody's screen, you're looking at a presentation that's talking about climbing the wall of worry, U.S. economic and market outlook. So you spend a whole lot of time talking about a lot of positive things that are happening in the marketplace. And it's not that I want to end on a pessimistic note, but what keeps you up at night? What are you worried about that could derail a lot of this optimism right now?
Well, I mentioned in Europe the risk is the geopolitical risk of the Eastern Front, so to speak. If we look at the U.S. economy, the thing that that I think we as a nation have to worry about is what happens if the Middle East goes very wrong. ISIS, etc., Iran, and if the price of oil goes back to $100 plus, the U.S. economy takes it on the chin. That's I don't call it a black swan, because a black swan you don't expect, but that's something which I look at as saying it's the number one risk. I don't think Washington is going to blow us up, not between now and a presidential election. We're not going to go to war with China. So, you know, those kinds of threats, but the Middle East could go sideways very quickly. Aside from that, maybe there's something I don't see. But I think that the last 5 years, and I think this is part of why I call it the wall of worry, the last 5 years have not been great for Main Street. Wages haven't really risen. Businesses don't feel like they're prospering. Because when the unemployment rate is 10 or 9 or 8 or 7%, it just nobody feels real good about life. And it has been good for the stock market. It's been good for the bond market, and real estate prices have gone up. But when the Fed starts raising rates and the wages start rising because the economy is at full employment, I think to some extent the party changes, and Wall Street maybe suffers, right, turbulence, because when the Fed starts raising rates, the bond market has bumps and the stock market has bumps. But Main Street will be partying. And I think the mood of the public 18 months from now will be much, much better than the mood of the public today. And I think if that's when you really start to worry. You know, it's not the first martini that causes the stupidity. It's the third martini that gets you in big trouble. Okay. And we're not quite there yet, but we're starting to see the mood of the public change, and we think that people are going to be more optimistic, and so there could be some headwinds for Wall Street when the Fed raises rates, but not for the economy. The economy actually will probably be just fine.
Wonderful. Sam, I can't thank you enough. For everybody that joined us on the call today, we appreciate your time. As always, if you have any questions, feel free to give us a call, 866-581-5724. You can email us at support@LSA Portfolios again, support@LSAportfolios.com. Once again, Sam Wardwell, the Chief Economist with Pioneer. Sam, thank you so much for your time today.
My pleasure, as always. Thank you.